Hi, I'm Jimmy. In this video, we're going to look at what's been happening with the Federal Reserve and what it could mean for us individual investors and ultimately what it means for the stock market. And then hopefully we can use this information to make better investment decisions or even better decisions with our money in general and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right in. So first, let's look at the very basics of what the Federal Reserve is there to do. Ultimately, the goal of the Fed is to try to get the country as close as possible to maximum employment while also maintaining or keeping stable prices on average goods and services. So we want to remember that those are the primary goals of the Fed. Now, the big news that came out of the Jackson Hole Economic Summit that just happened about a week or so ago was that Powell, the Fed chairman, he came out and said that the Federal Reserve is going to adjust how they look at inflation. So basically, here's the way it's worked up to this point. So the Fed sets a target inflation rate. That target rate has been 2%. And just so we're all on the same page, what a inflation rate ultimately means is that let's pretend inflation is 2%. Well, that means that if we had $100 today and we go out and we buy average goods and services, milk, bread, things like that, well, our $100 would buy us X. Well, if inflation is 2%, that would mean that this time next year, assuming it stays 2% for the next year, well, that very same basket of goods would now cost us $102. Now, some people argue that this is a chart of the CPI, which is Consumer Price Index. Some people argue that this isn't a great measurement of inflation, since it leaves out things like healthcare or school costs, higher education, things along those lines. And while that is very true, it is one of the more popular economic indicators, and it is one of the main ones that the Federal Reserve uses, at least to measure inflation. So I think it would be foolish of us to simply ignore it. Either way, the Fed is targeting 2%, and this is what they define as a reasonable level of inflation. Now, I do think it's important to point out that inflation is not a bad thing. Sure, as a consumer, it's not great for us. I mean, I'd rather the prices on our goods and services don't go up. But to effectively run an economy, it is very important that inflation be low and it be stable. Now, we might ask why. And we may be able to tell by looking at this chart that the Federal Reserve, nor any other government agency or any other person, sets inflation. It is not set. It is something that occurs naturally in an economy. And we might notice that when the coronavirus hit the economy, well, inflation fell. And this makes sense if we think about it because people were getting laid off, people were unemployed, so they had less cash. If they have less cash, they were going to cut back their spending. Even if it's simply fear, even if somebody didn't lose their job, perhaps they're afraid of losing their job, so they cut back spending. If there's not as many people out there trying to buy goods and services, the companies that we buy, the stores that we buy products from, could either lower prices, keep them the same, or at the very least, they're going to increase them less than they normally would have. That is what causes ultimately lower inflation. So high unemployment usually drives inflation lower. So I do think it's important to point out that this line is measuring year-over-year changes. So right now, inflation came in at 1%. That means on average, prices are 1% higher than they were a year ago. So let's say inflation is hypothetically 5%. What does this mean for us? Well, it means that goods and services are 5% more right now than they were last year. And if that's true, well, what's our best move? Well, holding cash doesn't make a lot of sense because cash next year is going to be worth, in theory, 5% less than it is today. So if we wanted to go out and buy a car for, let's say, $10,000, sure, it's an affordable car that makes the math simple for us. But either way, if we wanted to go out and buy that car today, we have a choice. We could buy it today for $10,000, or if we waited a year, we could buy it for 5% higher. If that's the situation, many people will opt to buy it today. More people buy things, the economy, in theory, moves higher. Okay, now what about the flip side? What if we had negative inflation of negative 2%? They call this negative inflation deflation. When it's negative, they call it deflation. And deflation is generally a bad thing for the economy. Why? Well, consider the very same example. If we were considering buying a $10,000 car, but we believed that that car would be cheaper next year, well, it makes more sense not to buy the car. In fact, it makes way more sense to put money in the bank and do nothing with it. Just sit on it because that money will be worth more in the future. If everybody stops spending, economies come to an absolute standstill. So the Federal Reserve knows they need to avoid that. So clearly, deflation would be a bad thing for the broader economy. Now, it's also bad if inflation were to get too high. If we were to have 7 or 10 or 15% inflation, that's a bad thing as well. So they're going to do everything they can to prevent that from happening. You want low, stable inflation. So to keep, let's say, the maximum level of employment, well, the Federal Reserve its job is to try to use something like interest rates as an example, or one of their other tools, but we'll focus on interest rates. They're going to use interest rates to try to control the level of inflation to keep the economy moving at a reasonable pace higher. Okay, so now we have a baseline, but here's a real question. What's the difference in inflation between 1% and 3% from an economic standpoint? The real answer is not too much. On a individual month basis or an individual quarter, if it's 1 or 1.5 or 2, it's not that big of a deal. And we can see over this 20-year time period or so, that's about where inflation has trended. And here's where the Fed is stepping in and really changing things at this point. So the Fed said that they are no longer going to adjust, let's say, interest rates to try to get inflation to land at the 2% mark. So the orange line here represents the Fed funds rate. That's the interest rate that the Federal Reserve has the most impact on. Now, technically, the Federal Reserve sets what is known as the discount rate, and that's how much they charge banks for overnight loans. But it's very close to what this does. So the concept is the same. So we had this data, so that's what we're using for this chart. So we can see that back in the early 2000s, inflation was rising, the economy was doing well, and the Fed reacted by increasing interest rates. Now, the reason that they would do this is that, in theory, higher interest rates would make it more expensive to borrow money, which leads to less spending. So it's their way of sort of slowing down the economy to a reasonable level. Now, in the financial crisis of 2008, 2009, at least in the early stages, inflation was on the high end. But there were signs that real estate and the financial sector were in trouble. So although it seems counterintuitive when we're looking at just inflation and interest rates, well, the economy at that time looked like it was in trouble. So the Fed stepped in and started lowering interest rates. But then inflation got real bad fast and went into the deflation category. And that, like I said before, is a problem. So the Fed lowered interest rates even further, trying to spur additional growth. They were hoping that this would incentivize people and businesses to start spending more and ideally move the economy higher once again and get out of the deflation category. Now, if we were to shorten this chart up to just 10 years, well, we can see that over the past 10 years, inflation has been fairly low. It's been fairly stable, despite the fact that we've had low interest rates for a large period of time here. So the Fed, during that time period, did fairly little to affect interest rates since inflation seemed to be under control. But then inflation began to rise once again, so the Fed started moving interest rates higher as inflation passed the 2% level. Now, we need to remember that some inflation is good for the broader economy, but not too much. So the Fed was reacting to the fact that it was possible that inflation continued to move higher. And then when inflation looked like it was settling off, it dropped back below the 2% level, well, the Fed settled off interest rates. So this brings us back to what Powell said at the Jackson Hole conference. So he said that the Fed is going to be less concerned about a single rate of inflation, the single point in time. Instead, they're going to use an average rate of inflation. Now, he did come out and say that he won't be driven by a specific formula, so they failed to tell us what that average is. Is it an average over the past 3 months, 6 months, 12 months, 5 years? They didn't say. But they just said instead that they're going to use an average versus a hard number. Now, I was curious what that might look like and what we could consider. And I think looking at something like a 12-month average could make sense. So I recreated this chart now using a 12-month trailing average for inflation. And this is what that would look like. And as we might expect, this chart looks much smoother than the individual hard numbers, but we can also see that on average, most of the time for inflation has been spent below 2%. And that was one of Powell's points. If they try to turn things around every time it gets near 2%, well, you're going to end up with an average lower than 2%. If, on the other hand, you pay more attention to the average, you could probably do a better job of landing at 2%. So here's why this matters, and ultimately matters to us. This increase in interest rates right here probably doesn't happen under the new policy. Because at that time, sure, inflation had jumped above it, but if they were using a 12 month average of inflation, well, it didn't approach it until nearly about 2018. So we wouldn't get above 2% for a while, maybe on the tail end of it, but that's it. So for us, what this ultimately means is that, let's say inflation got to 2% or even moved higher, let's say it got near 3%. Well, it's likely that the Fed would allow, where they would have perhaps increased interest rates before to try to cool things off a bit. Now they're saying they probably won't, since the average would not be there yet. So with all the activities of the Federal Reserve lately, where they've been pumping a ton of capital into the system, well, inflation is one of the fears. It's a natural reaction to putting a lot of cash into the system. So this is basically the Federal Reserve saying that they're going to allow more inflation to hit the economy and ultimately give the economy more time to run higher, since in the long run, they also have to get unemployment down to a reasonable level, or as they define it, get employment to a maximal employment for the country. So ultimately what they're saying is that inflation above their 2% target is perfectly fine as long as it averages out to about 2%. Now, I have heard some other YouTubers imply that, let's say that the Fed, inflation was 1% a year for a few years. Well, with the Fed's new policy, if the next year was 15%, well, that would be fine as long as it averaged out to 2%. And I can very confidently say that that is not at all true. Not if the Fed is being at all responsible. Their job is to keep inflation at a reasonable level, not let inflation run up really high, or not let deflation hit the economy either. So them moving interest rates around, or putting capital into the system or taking capital out of the system, a lot of people call this market manipulation, and it is, but that is their purpose. That is what they are there for. So what does higher inflation ultimately mean for us? Well, it means that our money is going to be worth less next year than if we just were holding the cash. So if we had $1,000 or $10,000 or $100,000 and we just held on to that cash, it's going to be worth less. The Fed's news was that they're willing to let it be worth even less than they previously were okay with, which could have an interesting impact on our investments. And that's because higher inflation often leads to higher stock prices and often leads to higher real estate prices as well. So this move by the Fed actually points to it being a good time to consider investing, to not just be sitting in cash or having our money in a checking account where it's not earning anything. Now, I'm not implying that we don't have some sort of savings fund or something like that. I'm saying excess capital, if we have it, investing makes sense because the Fed is saying they're going to continue to push things higher. Now, I also want to point out that this actually helps the US government as well, since the government can borrow money ultimately at about 0% right now. And if inflation is higher than that, which it is right now, well, in theory, the government could simply go out, borrow money, which there's practically no interest on, and then they could simply let inflation chip away at the principal value of that. So if they issued 30-year bonds and borrowed $1 trillion, in 30 years, it's going to be worth nowhere near $1 trillion because you'd have chipped away 2% a year for 30 years. Now, I'm not saying that's why the Fed did it, but I'm not saying that's not why they did it. It certainly doesn't hurt the government. Now, if you're looking for some good stock ideas that could be good investments over the long run, well, I actually did a video where I talk about 5 forever dividend stocks that could be good investments. So if you like dividend stocks, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.